All right, let's bring back in our global economics analyst, Saruhan Hatipoglu. Saruhan, let's focus on the Fed and the Fed's decision to keep rates unchanged, widely expected. But given that the U.S. stock market is off to its worst start of a new year ever, all three major indices falling into correction territory, and the eco data, well, not that robust, do you think the Fed may have raised too soon?
Michelle, I think the Fed was a little late raising the rates, to be honest with you. We expected that to be done in September or so because free money was available for too long of a period, which contributed to the stock market overvaluation that we see today. Now, Fed's job, again, let's remember, its job is macroeconomic fundamentals, employment prospects, and inflation. And today, some clients of ours actually view this as a dovish statement. But I didn't look at it that way because Ms. Yellen said, look, labor market is improving. Inflation is going in our direction in the medium term. And she mentioned global economic problems once in the report. That shows that Fed is not really focused on the global economy, but rather things that are happening at home. And when we look at those, I am afraid that there will be a March increase. We don't anticipate, we don't want that to happen because that would be too soon. But there will be interest rate increases this year, 2, probably 3.
Well, Saruhan, you mentioned the growth in employment, but wage growth has been quite stagnant. That's been a concern. And another concern has been what we're seeing with the markets and that the Fed has gone the opposite trend of other central banks. And many are saying that, you know what, this could lead the Fed to reverse course. Now, since 2008, other central banks had to change their mind. Sweden, Israel, Canada, South Korea, New Zealand, Australia, they all tried and failed, just to name a few countries. What would it take for the Fed to reverse course? What would need to happen? How bad would it need to get?
I think there would be another 10 to 15% downfall in the stock market with a lot of global economic problems, more than we're seeing right now, actually, for Fed to reverse course. Now, let's remember, if Fed reverses course, that sends another message to the market. And that message, Michelle, is we don't know what we're doing. We increase interest rates we shouldn't have. That would be an admission of wrong policy move, which is something that the investors would not want to see. So I actually would not want to see Fed reversing course. I just want them to continue what they're doing in an orderly fashion, not hurrying interest rate hikes as early as March. And again, Ms. Yellen is a labor market economist. So she's looking at employment figures, she's looking at inflation. She's not looking as much as people think she should be or she would be to the stock market.
But would further tightening of the money supply tip the U.S. economy into recession?
Well, I don't think so, because the data itself, Michelle, is not that bad. We just looked at the consumer confidence numbers a couple of days ago. It's looking really good. Employment is improving. There are some good numbers coming out of the macroeconomic fundamentals, and that is the reason the Federal Reserve did what it did in December, and I think it will do what it will do in the next 6 months or so. We need to, or the investors need to understand that the job itself is not stock markets or controlling the stock markets, making it go further up. The goal is to not allow runaway inflation, which could take place if the consumption picks up, which there's pent-up demand because of the decline in oil prices and all of that. That may actually come into play sooner than we think, with retail sales in the increase based on, again, consumer confidence numbers. This is what the Fed is trying to do. I think it's too early to talk of recession.
Well, one thing that has been concerning both investors and potentially the Fed is China's growth slowdown. Now, the economy is rebalancing. Some slowdown is expected. The latest GDP data was at 6.9%. What's your outlook for China?
I think based on the numbers that we're looking, we're happy with what's going on. I told my clients around October of last year, I said if 2015 data show that China's GDP accelerated, this is time to get out. We do want some orderly slowdown in China because of this huge transition that's taking place from one based on investment growth to one that's consumption-based economic growth. And if you look at the numbers for 2015, that transition is taking place. 65% of GDP growth is because of consumption, which is very good. This is the largest in 15 years. And also, if you look at service industry, Michelle, it's about over 50% of GDP, 10 percentage points over manufacturing. So this transition is taking place. China is going to slow down. And if China accelerates growth in the next 6 months or so, using the old policies of fiscal expansion, infrastructure spending, and monetary easing, permanent monetary easing that is, decreasing required reserve ratios, that is not good news. I know the market will react very happily to that, but I'm more looking into midterm to long term, and that would be a mistake. China is slowing down, it should slow down.
Okay, as always, thank you for your insights, Saruhan Hatipoglu, Global Economics Analyst.